says live on here, by the way. It's not live. This is just being recorded, so just wanted to make that point. But I'll kick it off. My name is Max Gagliardi, and I'm here with David Heikkinen, and we're recording this week's episode of Talk Energy Insights. And we've got Danny Brown, the CEO of Oasis Petroleum. David, you want to kick us off?
Yeah, and thanks, Max, and thanks, Danny, for coming on. So we've known Danny actually for a long time, back to his Anadarko days, and whenever he joined as CEO of Oasis, we really wanted to get with him and talk to him about, one of the younger leaders in the oil and gas space, and kind of how he thinks about, managing the oil and gas independent world, at a company that has a crystal clear and clean balance sheet. Just for perspective, we're recording this on November 17th, and the stock closed close to 128. And on our numbers at Pickering Energy Partners is trading at less than 2.5 times next year. And that by definition is a cheap stock. We're not making recommendations on this, nor does that reflect a recommendation. But really what we wanted to do was take a step back, because I think I met Danny, too long ago to say. I know I'm a little bit old, but what I thought would be helpful is, kind of let Danny introduce himself. We'll then talk about really where Oasis Petroleum is going. We can talk a little bit about the transactions you all have done this year, and kind of the focus that you have, and then we can close with just kind of some quick hits. And Danny, we were talking right beforehand about another Bakken company that recently installed some Bitcoin mining on their asset, where they couldn't get a gas right away, and put a JT cooler on, or producing 5,000 barrels of oil a day, and also not flaring or venting the gas. They're actually converting it into a store of value. So we're Max and I obviously talk a lot about Bitcoin in time, but we be happy to either online or offline, we can talk some more about kind of where things are going, and why we're both there. But so Danny, thought we'd just start, hand it off to you. Just kind of introduce yourself. One thing that anybody that's worked with me knows is I always ask, throw something in that would surprise me and us, that not everybody would know about you as well. So okay. I'll hand it off to you.
Curveball there.
Yeah, I'll do that. So first, I'm super grateful to be here. Thanks both of you for hosting, and David for suggesting we do this. It's my first podcast ever, even if it is pre-recorded. So anyway, thank you. I feel like I'm moving into a new medium, so that's great. Maybe a little about my history. David mentioned my previous employer, Anadarko, was with Anadarko, or a predecessor company, for 23 years. Left with the acquisition of Anadarko by Occidental. Finished my time at APC as the executive vice president over our U.S. onshore operations, and so that, for APC, that was probably 2/3 or 3/4 of our business. So pretty big. Lots of moving parts. I think we were doing net probably 500,000 to 600,000 barrels equivalent a day net through that onshore position at APC. So it was a lot of different basins. Had a great fun, great career over there. Prior to that position, I was the executive vice president over our international and deepwater development. And so I spent about half my career in the Gulf of Mexico, or international conventional developments, and about half in U.S. onshore. And it's really, in some ways, very different businesses from one another, all in hydrocarbons, all delivering hydrocarbons clearly. But, the pace of business is different. The technology that's employed is very different. The types of contracts very different. And so anyway, it was always really enjoyable to me to have a bit of foot in both waters, and move back and forth between those two types of, those two aspects of E&P. Loved them both. And in fact, I'm still on the board of a private equity-backed offshore company still to this day. And so I get to sort of scratch that. Yeah. Yes, Beacon Offshore. So I get to scratch that itch a little bit, and we just may have seen sanctioned a big development now in the Gulf of Mexico here in the not too distant past. So anyway, it's great stuff. Love the industry. Very, very happy to be with Oasis Petroleum. One of the areas where Anadarko didn't have a foothold was in the Bakken. We were interested, and so I can remember years ago looking through maps and logs and subsurface characteristics of the Bakken. Probably back 2015, 2014 kind of time frame. Considering whether or not we would want to get into that basin. So I never had a position there. it's part of the appeal for me to come in with Oasis. Intellectual curiosity has always been a big thing for me. And so it was an opportunity for me to come into a situation where it was new basin, which was interesting. And frankly, it was, I think, given the acreage position that Oasis had, the clean balance sheet we had through a lot of tough times to get to that point. But it seemed like a fantastic opportunity to get into a great asset with a great organization. And importantly, for me, to get back into industry, I took some time off. I was out of industry. I was on a couple of boards, but wanted to really get back in the game. I love the industry. I just really like the industry. I like what we do. I think we do something that's good for society and for people. I think we put a lot of effort into doing it the right way. I know Oasis is doing that. We could talk about that some as we go through the discussion. But love the industry, love the people, and am happy to be back in it.
Yeah, and
that's just about me.
Yeah, just kind of pegging time. Just so everybody knows, you joined Oasis this year. You're going through your first, really next year budgeting cycle now, I'd imagine. And so you just talk a little bit about, contrasting what you've seen at Oasis to Anadarko and kind of the smaller company versus larger company, and just kind of walk us through a little bit of, for not everybody that knows the company, kind of where you are, some of the divestitures and rolling in midstream, like just you're kind of thinking through those decisions that you've made since you've been there, and then acquisitions as well. So
yeah, great. So let me introduce Oasis to folks who aren't familiar with it. So Oasis is we're now essentially a Bakken focused producer, E&P organization. We have really the company was founded in the Bakken, and so that's been the core position of the organization since its inception. We ventured out and built a position in Permian Basin a few years ago. I joined the company in April of this year, and when I came into the organization, this was post restructuring, and so the company went through bankruptcy in the latter part of 2020. Emerged last November. In fact, Friday will be 1 year since emergence for the organization. And so if you go back and look at, you mentioned we closed at 100, around 128 today, slightly under that. We emerged at around 30. And so it's just amazing to me the amount of, and still, to your point, feel we're undervalued relative to peer group. So I still think we've got some running room, not investment advice to your point, but anyway, it's just looking at the landscape. So tremendous progress made by the organization since emergence. I came in April, and at the time we had position in the Permian Basin as well as Bakken. We've done several different, I think, important works within the organization post emergence. One of the most important things we did, and I'll get to some of the transactions here in a minute, is we really did a lot of introspective looking on how we do our business. How do we benchmark versus peers? What does our operating costs look like? What's our cost structure look like, sort of writ large? One of the important things about this is I think full recognition that we're in a commodity business, and in a commodity business, sort of low cost producer and margins are incredibly important. And so what that looks like, it should have a large impact on who competes most favorably in space and who's able to command investment dollars. So we went and we did that sort of look in the mirror and recognized we had room for improvement. So we started marching down some of those paths. And so we started cleaning up the cost structure, reworking some of our work practices, and we've been able to take a lot of cost out of the system. So that was important work for us to do up front. Simultaneously, we started evaluating the portfolio to see what sort of opportunities for improvement do we have within the portfolio. And I think we pretty quickly recognized that the Permian position we had, great acreage position, we liked it, didn't really see a very clear pathway to how we were going to be competitive within that basin. If you look, because it's a commodity business, some certain efficient scale is, I think, necessary in order for you to be able to be competitive. The acreage around us had all pretty much been consolidated. We didn't have anywhere to expand into that would have operational synergies. Delaware itself, as you know, Permian is a very competitive area, and so we didn't have the supply chains, we didn't have the workforce. It was going to be tough for us to make that work. And so what we did is we did a couple of paired transactions together where we divested that Permian asset and we bought the old QEP assets, then subsequently held by Diamondback. We bought those assets in Bakken. And so we were able to get an attractive value for an asset that we saw was going to be difficult for us to be really sort of competitively compete well in the Permian. And we were able to build scale in the Bakken in an area that we know really well. We do have a lot we can bring to bear, whether it be marketing, supply chain, subsurface knowledge, whatever it is. And so that made a lot of sense to us. So we did those transactions. Market liked them, which is always nice to get, not necessarily why you do the deals for that sort of initial reaction. Hopefully over long term, the value is evident, but I think the market saw the value in it right away, was received really positively, and we're really happy with the deal. We sort of further along with the process, outside of the E&P assets, we've also have a pretty sizable MLP, Oasis Midstream Partners. And so I think two really important transactions over the course of the year with respect to OMP. One was the structure of who held what between OMP and Oasis was very confusing at the beginning of the year. And as an outsider looking to join the company, it was confusing to me. And so I know it was confusing to investors and generalists. The ownership positions were different. There were the IDRs that still existed out. So the whole structure was confusing. And so we did a simplification transaction just before I joined the organization, where everything was dropped down to OMP, and it cleaned that story up. Part of the hope of that was that through that process is that we would start to see the Oasis shareholder, because of that improved visibility, would get some improved read-through value for the holdings we had in OMP. And I think we saw that to a degree, but not to the degree that ultimately we would have hoped for, where you saw sort of a full sum of the parts evaluation for Oasis. And so hence the recent transaction we announced back in October, that we are merging OMP into Crestwood Midstream. So they're a great operator. We've got great confidence in them. So this is going to be a stock and cash transaction, hopefully closing the first quarter of this year. So anyway, that should help continue to really illuminate the value of the underlying E&P assets and the discount we see ourselves trading at relative to the peer group, David, that you sort of started out with.
Well, if you ever talk to a CEO who says his stock isn't undervalued, then you should probably run away from it. So you're allowed to say that all you want. When you thought about kind of the midstream business, and since it is critical to the operation, Max and I've talked a lot about the midstream business, given his background. How did you think about when you were selling? There's infrastructure buyers, and then you obviously went with a strategic merge, kind of more on that side. What were your thoughts on that, and like the criticalness of value versus security?
Well, I think it's you've got to think through whoever is the ultimate buyer of these assets, which will be Crestwood. I mean, who that operating partner is at the end of the day is incredibly important to us, because our pipe, sort of our connection to the cash register and being able to get the E&P products out to market is going to go through this party. And so the counterparty was, having confidence in the operating capabilities of the counterparty were really, really important to us. And so, and I think, so that's a value question. But it's a long-term value question too. So I think it's a combination of who's the right universe of operating partner you want. What's the consideration you're getting? So what's the level of service you're going to get? What's the consideration you're going to get in the deal? Sort of the mix, and then total quantum of cash and equity. And then what's the right thing for both Oasis and OMP, importantly. And so as we looked at the transactions, this is one of these. I really do think it's great for all three parties involved in the transactions. We were able to accelerate some of the things we wanted to accomplish for OMP, increase basin diversification, increase customer diversification, true focus on midstream operations with a great counterparty. So it's great from that perspective. And then from an Oasis standpoint, we were able to liberate value at a reasonable price, and then remove, hopefully over time, as we're able to report on a deconsolidated basis, remove this cloud, have a better pathway to ultimate liquidity than what we had before, and remain a good operating partner with someone who we're very strategically aligned with. So it just worked out, I think, really, really nicely.
So when you think, and so, I talk a lot about a new CEO, the average CEO tenure in the market is 8 to 10 years. And so you're going to run this company really into a lot of what we see around some of the, emergence of other energy sources and, the thought process of being a U.S. independent in that. How do you think about Oasis's position and really leading a business, as you go through and into 2030 and beyond potentially? But just thinking about that type of time frame, where does Oasis fit? How do you see the future?
Yeah. So yeah, the seeing the future, I reflect back. So 10 years, what does the world look like 10 years from now? And so if I rewind the tape and put myself back into 2011 as an E&P, if I was an E&P CEO in 2011, what do we need to be successful? The answers, the answers are probably, the tactics might have been a little different than what ultimately, one should have followed in order to be successful, and certainly would be different from what you would think today, just thinking about what's happened since then. But having said that, I think there's a lot of elements that are, durable, and just for the management of any organization, regardless of what sort of, what industry you're in. So maybe broadly, when I think about from a leadership standpoint and senior leadership, so what's the highest calling of senior leadership? In my mind, it's kind of three things. It's capital allocation, and so critical. And I think as we think through energy transition and the rise of new sources of energy and what does supply demand dynamics look like moving forward, capital allocation is going to be a critical component of that. I think maybe alongside, tangentially related to that, so that's sort of calling one. Calling two is, I would say, is proactive risk identification and management. In some cases, maybe that's mitigation. Maybe in some cases that's actually flipping it on its head and finding an opportunity in it. And so that's going to be super critical. And it is for any industry in any sort of time frame. And then creating the right culture. And so those three things, I think, when you think about senior leadership, at least in my mind, that kind of comes to mind. So if that's able to translate for us in building an organization that's focused on returns, that's doing something sustainable, that's maintaining some financial flexibility by taking a conservative approach to things, but doing things right along with it, then I think that's kind of durable across lots of different cycles, and even in a transitioning industry.
Yeah, we've got a big bias of governance actually, and having the right alignment of board management and people solves a lot of the E and the S questions that come up a lot. And so when you think about your governance, where do you think where are your strengths? Like, what do you think a CEO should own in his business? Like, how do you think about that allocation of being aligned with shareholders, and what really establishes that as you join the business, as you think about your tenure? Where do you want to end? And I'm curious on your thoughts.
So it's funny you say that. So we had an almost identical conversation within the board construct, sort of very good conversation. That it's G. We talk about ESG, and there's a lot of focus on E. I think there's important focus on E. Focus on G. A higher focus on G may get a lot better results on both E and S and G.
Exactly.
And so G is an incredibly important part of this. And so I'll tell you, frankly, one of the things that I was excited about in coming into Oasis was the board we have. To be quite honest with you, it's a board of industry vets who are pretty forward-leaning, who I see the world sort of similarly to the way I do. And just as a little bit of a segue, I can remember back to doing our investor presentations back in late 2016 or early 2017. We were tweaking some, and we were talking about return on and of capital, and converting the annual bonus scheme to debt adjusted share metrics, so we didn't reward rampant growth, right? And so So the fact that industry has sort of moved that way now is encouraging to me, and fits well with sort of my view of the world. And the board we've got here is there. And so, I do think we've got some pretty good governance with respect to alignment. How do I align with shareholders, and sort of what do I own within the organization? I think it's at the end of the day, I've got a very strong and collaborative relationship with the board.
Mm-hmm.
I think there are oversight and governance by the board absolutely is required and necessary, maybe more so now than what we've seen in the past, given the change. If you're in a static industry, then I think it's never good in any industry to sort of not have good governance, but maybe the consequence of less than optimal governance isn't as severe as it is when you're in an industry at a high rate of change.
Yep.
And so governance in this industry right now, I think, is really, really important.
And I think your board and you guys did a great job aligning your proxy, and it was pretty forward thinking for a company your size. And maybe that's part of the emergence and being aligned across the shareholders. But no, I just singing your praise.
Yeah, no, I think it's great. And to your point, I think so for my comp, it's 75% return based, 50% of that on absolute return metrics, not relative return metrics. And so I am really, really structurally aligned with shareholders, and it's a multi-year grant. And so it's not something where I get reloaded next year. I'm in it over a multi-year period for what is largely absolute return appreciation. So I think that's something that structure and construct is very aligned, sort of very aligned for me relative to shareholders, which is a good thing. Frankly, it makes the investor conversations a lot easier that I have with folks, because we're very well aligned and see the world similarly.
Yeah, no, yeah. I go ahead, Max.
I was going to say, I don't follow the equities world as much as David does. And so I'm sure this is all out there, and I'm sure it's in guidance, and you guys have talked about it. Just for my curiosity, plans going into next year, whether that be development, what's the company looking to do? What are the goals? The overall theme that we see, and David and I talk about a lot, is this capital discipline, and a lot of guys aren't really trying to grow production. And that's kind of the broader theme that you hear, but it's also commodity prices are really good right now. And so from a public company CEO, you're thinking about, okay, here's what the general consensus is among E&Ps. You kind of got that going on. Here's our specific asset opportunities, and here are the market opportunities in terms of price. What's the current strategy, and how are you guys planning to play this here into the next year and the next 5 years? I guess if you can even go out that far.
Yeah, fantastic. So what I'm going to tell you is we haven't come out with the 2022 budget yet. So I'm going to talk in generalities, right? But I'll talk in specific generalities. We won't put a decimal point on anything.
Sure.
I think really the question is, one, back to what I talked about a moment ago, capital allocation. So how do we allocate our capital as an organization? Right. And as we think through that, I really think we kind of think through in multiple different buckets. One of those buckets is paying down debt. We don't, for us historically, that would have been a big call on capital with our balance sheet right now. So pro forma for the deal we do with Crestwood will actually be sort of in a negative net debt situation. So we'll got no real need to pay down debt. So let's eliminate that one. Second would be for us organic growth opportunities. So it's sort of, spot price is high. Should we pick up another rig and drill some more opportunities? I think the short answer to that is we don't plan to do that. And the reason why is if you look at the curve, fairly backwardated curve, we could hedge some of that in. But ultimately, when we look at the supply demand dynamics, it's not so much price, but durability of price that really matters, and your conviction that price is going to be durable. And I can make a bull case and I can make a bear case. What I know is we're probably not smart enough to figure out which one of those actually, with certainty happens at the end of the day. But with, potential for inventory builds toward the back half of 2022, sort of, I think, uncertainty with respect to where does COVID ultimately settle out? Do we see another wave come? There's lots of structural uncertainty there. And so it's our belief that there's no call on us to pick up a rig and continue to produce. that doesn't mean, so let's pull that one off the table now. Let's say we're going to do maintenance capital to keep the pro forma organization together. So as a company, because we picked up that QEP asset, we're going to grow significantly year over year, but it's going to be through organic growth, not because we picked up a rig, but because we think we made a really creative acquisition for the organization. So that's I think that's fantastic growth for us. So that leaves us with the last two buckets we look at, and that's really inorganic growth opportunities. So are there more opportunities for us to do that sort of acquisition, even at this point in the cycle? And I think the short answer to that is we think there probably are. Now, whether or not we can actually transact is, that's a different story, but we think there's probably some opportunity for us to do that. And then the last bucket is return, and not because we think about it this way, but then it's return of capital. And so that's so those are sort of the four buckets we think about capital allocation in. And we've done a lot of return of capital so far. We got a dividend out pretty quickly. We increased the base dividend already. We paid a $4 special dividend when we did some unit sales on our MLP early in the year. And then we got a share buyback program, that $100 million share buyback program that's authorized and open. So as we think about 2022, for us, it's about let's maintain production of the pro forma enterprise post the pickup of the Diamondback assets. And then let's look at, we're going to generate a ton of free cash flow with that. And so how are we going to balance that between our return of capital strategy and any inorganic growth opportunities that might come along our way?
That's great. Let me ask you this, just in terms of, talked about these different buckets, but what about access to capital right now in terms of public markets, from the bank side of it? You've got inflation running hot. Obviously, commodities do well during this time period. You would think that there may be some sentiment changing in some of these markets. You've got maybe the stronger balance sheet, and you've got, like you said, the free cash flow. So maybe from the lending side, as you think about capital structure and moving forward, where there are opportunities, or just your thoughts in general around access to capital for groups like yourself or companies positioned how you are and how you're looking at that.
Yeah, so I think from a access to capital, much better than it was, rewind the tape just a few months ago. Much better now. Both, I think, from an equity and a debt standpoint. And so I think that it's there if it's the right thing to do. Still not nearly as many banks in as there were before. A lot of the Europeans are gone, so it is not the exuberance or the sort of free access to cash that there was a few years ago. But I would say maybe it's gone off from pliers crimping it down to someone just sort of pinching it back a little, somewhat. So, it's not wide open, but I mean, it was very, very, very tough before, not very long ago, and lots of as people were going through mid-year RBL redeterminations and whatnot, there was a lot of fear on, are we actually going to get people to recommit and move forward? I think some of that has ebbed within industry, but still, so better than it was, not nearly like it was a few years ago. But frankly, I think that open access to capital would probably incent the kind of behaviors that probably aren't very good for industry. So that's not bothersome to me. Yeah.
David, what do you got?
Yeah, just kind of thinking through what you've hit, and just as I think about stocks over a long period of time, debt adjusted cash flow growth per share has been a pretty good metric. There's an inherent bias of share prices in that, but it used to be you had to grow your production faster than your debt went up or your share count went up. And I think it's still going to work as you've reduced debt. That's a benefit of lower interest expenses, and you can transfer that into dividends that go to equity holders as opposed to interest to debt holders. And then your share count goes down. And so you can still have, cash flow on a debt adjusted basis grow. It's just pulling different knobs of the same factor. You talked about it at your time at Anadarko in 2016 when you started moving, really into the per share thought process. When you think about that knob of free cash flow, do you think investors, if you said, hey, we're going to be a high debt adjusted cash flow growth per share company, would they hear this company wants to grow cash flow, or would you be able to really press them into, we've driven debt to net negative, we've got acquisitions that can grow cash flows at potentially, well, it's tough to get cheaper multiples than where your stock price is, but in line, and then your share count won't go up. It'll likely go down over time. How do you think people would respond to that?
I think there's some proof is in the pudding. That is from an industry perspective, we need to get to for any investors, just to get sort of investors back in regardless and excited about the space. I still look at you can, whatever, if you want to use a sort of fraction of S&P and energy, or you see those sorts of things, multiples we're trading at currently relative to because I was thinking as you were talking through that, David, I don't know what the exact numbers would be. I'm gonna, after this is over, I'll go back and run them, but I'd be curious to see sort of debt adjusted growth metrics in the past when debt was growing, and I'm not sure that there was actually a lot of accretion on those sorts of metrics, yet the multiples that the equity was commanding relative to the multiples we're getting now, when I think absolute debt numbers are shrinking, and you're probably seeing is maybe some of the same debt adjusted share, accretion on a debt adjusted share basis, but you're clearly at much lower multiples. I think we're in a prove it period right now, and so we're all talking about return of capital, and we're all talking about financial discipline, and I think there's going to need to be some period where folks actually see this translate to discipline, either significant increased share price in a higher price environment where E&Ps maintain some discipline and some prudence and sort of continue their commitment before we really start to get traction, regardless of what thematically what they're talking about. Just my thought. I'd be kind of curious I don't know, does that ring true with you guys?
Yeah, I can just tell you, like, if some of the companies that have defined those hard ceilings of, we're GDP growth rates, or we're 5% growth rate, and we're going to return the cash beyond that, if they break that trust that is developing, and grow at 10% for some reason, I think investors will walk away from those companies faster than they'll run away, actually, and you'll see big underperformance of violating that trust. And I honestly think that they will never come back to those companies either. And so it's this really interesting and tenuous situation of the world may have a call on the U.S. for growth, and I think we're delivering some growth next year just because of, like you said, there's some latent carry forward into the exit rates are higher than the entry rates for a lot of companies, and seen a lot of private company growth, and we actually are seeing the Exxons and BPs and Chevrons still growing, but the base independent on the public side is showing real discipline, and so I think that's something that's critical. It's the way I thought about it. One question just on, while you were at Anadarko and on the board of West, there's a big push towards closed loop and tankless systems, and you had a lot of that in Colorado. How do you think about lowering Oasis's emissions, and employing, moving into that type of system away from the tank battery and pneumatics, and just kind of I call it the greening up of the oil field that is happening. And the trend is improving, but can you talk about deploying the same type of things that you did at Anadarko now, or is it already happening at Oasis?
Well, so I think some of it's already happening. It may look a little different than what we did from an APC perspective. Of course, we had the advantage there of sort of, in many ways, building those fields out from scratch, and a little different than where we're at now, and with the way the infrastructure is set up within the Bakken. But doesn't mean it's not a good news story, regardless. And so we came out with our inaugural sustainability report, which I think was an important step for our organization earlier this year. So it's online on our website currently. And what I was really pleased to see is we saw a lot of significant improvement from 19 to 20. And I'll tell you what some of and not just in absolute terms, because I think a lot of people probably saw absolute improvement from 19 to 20. And it's just because 20 was such a odd year, and, wells were shut in and whatnot with all the pricing dynamics, but the intensity around it. So the per barrel metrics had improved significantly over that time frame. And we reduced our methane emissions and our total GHG emissions by about 50% from on both those metrics from an intensity perspective from 19 to 20. And so And the reason behind it is we've taken steps on a few different items. One is the gas-powered pneumatic controllers. We've gotten rid of all of them, and so we don't have those within the system anymore. And so those have all been removed and replaced with either instrument air or electric actuated components. And so that's out. All of our flowbacks, we flow all that back into process equipment now instead of flowback equipment and flaring, and so all that stuff is being captured. We upped the game a bit on our LDAR efforts, which I think was important, and did honestly just some small things. Like one thing, and frankly, I don't know how we did this at APC. I'm kind of curious on, we might not have had a best practice back there during the time, but you find a leak, you've got your cameras around and you find a leak, and then you put a work order in, and then it takes some time for the work order to get filled when the person actually gets out there and then gets the leak fixed. And so a lot of focus on what's the actual time to repair once the leak is identified, which is sensible, particularly, and really sensible for the larger leaks. Well, what we recognized was, there's an easy way to fix this. Just get the same guys who would perform the repairs to be operating the cameras in the first place, and that way, as soon as it's discovered, it can get fixed. Yeah. And so those leak repair times have gone down to like hours, because literally they're on site, they see the leak, they go get it fixed. Now sometimes there's a special piece of equipment that's needed, but it was dramatic improvement in the amount of time it took to get this stuff fixed, which is just a sensible step to take.
Simple, yeah.
Yeah, simple. Simple and frankly a more efficient way to run your business, because now you don't have all the windshield time, all the processing time on getting the work order done, making sure that's cleared, the bureaucracy associated with that, etc. So just a smarter way to do things. And so anyway, we've seen these big reductions. The other area where we were pretty advantaged relative to the peer group in Bakken is because we did have OMP and we had the midstream provider. The pipe was always there for us, and so as an operator, we weren't generally stuck in situations where E&P had drilled wells and had nowhere to go, and we couldn't. And so we're looking at flaring opportunities or Bitcoin mining opportunities, as the case may be. We actually had the pipe there so we could capture it from the get-go. So the the capture rates for our stuff has all been really, really high. So all that to say, I was as we put that sustainability, the day before we put the sustainability report out, I actually don't remember who it was, and I wouldn't say regardless, but one of the other E&P companies came out and said they were stating a goal that they were going to reduce their GHG and methane emissions by 50% by 2025. And of course, I don't know what their baseline was, but I sort of smiled to myself and said, well, we did that last year, so that's good. And that's not to say we won't do more going forward, but anyway, we've done some good efforts at the organization. I think we're in a pretty good place, and with continued focus on moving forward and continuing to improve.
I was going to ask this real quick around another theme Hike and I have talked about a bunch is the service costs and the OFS side of the equation. And I work with a lot of our company works with a lot of private E&Ps, and hearing that, everything from I got friends that own just a couple, they operate a small field of wells to guys that operate hundreds of wells. But, I had a buddy the other day that operated just a couple wells, and he called up a couple workover rigs, and they laughed at him when he asked on their timelines for some of the things that he wanted to get done. They were like, you're clearly not in tune with what's going on, at least, and this was in a different market than where you guys are at. But what are you seeing on the OFS side? From the cost perspective, is that going to, hurt a little bit of those margins in terms of if you want to do new things like drill new wells? Is access to equipment, lead times, is the supply chain craziness in the world? How are you guys navigating that space, and how does that impact your plans moving forward?
Yeah, no, it's a great question. So we're absolutely seeing pressure from an OFS side. I'd say, and it differs depending upon what product line you're talking about. And so in some areas, and like anything, some areas are, we don't really see any tightness at all, and other ones are pretty dear. I think everyone's sort of familiar with some of the stories around steel and maybe trucking. Those maybe, I don't know if they're getting better, but maybe the rate of getting worse isn't nearly what it used to be, and we're learning how to deal with that better. Wage inflation is something that's happening, which is sensible, particularly consider the backdrop of just general inflation we're seeing, we should be expecting that. So we're seeing that, and that's obviously going to work its way through into the cost structure. Trucking really has been a big issue for us as we, North Dakota there's been a bit of, there's always a lot of out-of-state workforce within North Dakota. And so the fact that, as you move into different service aspects, trucking is one where if you can drive for Amazon or maybe do an Uber instead, so you're still sort of using those skills you're just using them closer to home and don't have to make the big commute. So as some of those, as some of the economy has changed, and I think maybe driven somewhat by the pandemic with people ordering more stuff off of Amazon and sort of e-commerce taking off, that's been hard to get back into industry. The iron is there, and so the equipment availability is there. The issue for us, I think, is really going to be around labor and can you get the crews put together in order to do something. And so I think the thing that's helping us out in this is the fact that we are seeing moderation and some capital prudence by a large swath of the U.S. onshore sort of unconventional producers. And so you're not seeing as much supply-demand drive on the OFS side where it's just really elevating prices and people are doing unnatural things to try to get the crews put together. But even with that capital discipline, if you don't have good, I'd say if you don't have good supply chains or really strong relationships with your suppliers, you may see there may be difficulty getting certain services over the course of the year. If you've got those two things, I think you're fine. But if you don't, I think you're going to struggle. So picking up something spot, just calling up and picking something up spot is going to be tough for someone unless you've got a really deep, long-standing relationship. And then someone else lose it.
Danny, can you maybe, just for the listener, size the business? Like, talk about, what is your current activity level? Like, wells you're, targeting, particularly post QEP as you start kind of fitting things together. Yep. I know this isn't trying to get to guidance, but like size of, 70,000 barrels of oil equivalent. We've got X rigs. We tend to think about this much capital per year, and some of that would be helpful.
I probably should.
Employee count. Yeah.
I should have let in with that early on as I introduced the company. So so pro forma for the QEP deal, which we just closed. So the organization now is running about 75,000 barrels a day equivalent. We're kind of letting that float down through the back part of the year, just with activity level. So we're going to cross and kind of maintain in 2022, call it roughly 72,000 barrels equivalent a day. So that's roughly the site net. So that's kind of the production size of the organization. We think we can hold that, generally hold that flat for around $300 million a year. I'll tell you, when I'm saying 300 million, that's kind of today's dollars. And so, and we've seen inflation happen through the course of 2021 as well. And so I'm incorporating everything we've seen kind of to today. And going forward, on top of that, I see maybe, call it 10%. And we're working to battle that back. So is it 10 and it turns into 7 because we're able to offset some? Maybe am I wrong? And is it's actually 13 and we get it back to 10? Could be, but kind of in that number. And so call it 300 with some upward pressure on it as we work through inflationary aspects. For us, that's about, call it 65 wells a year. And so 65 wells a year will take 2 rigs in a little bit. And so so we'll probably run 2 rigs through the course of the year and maybe pick one up. It depends a little bit on what's your makeup of longer laterals versus shorter laterals and the timing around that, et cetera. But now it probably gives you a general picture.
Yeah, blame that on the moderator to not ask you the size of the business at the beginning.
Well, I should have started with it.
I'll take that one. But
yeah.
I did say I kind of wanted to hit some things that people may not know about you, and so I've had these quick hit questions that I stole from Dr. Michael Gervais, and he has this Finding Mastery podcast that I'll plug, that he tends to ask people just to understand and helps people understand, get to know you. So little background. So Danny's an A&M mechanical engineer and got an MBA at Rice. So I'm betting we're going to bias towards the engineering outcomes. So let's see if I pre-predicted. I'll tell you guys afterwards what you got. So do you think of yourself as street smart or analytical?
I would say maybe depends on the situation. Maybe a little more street smart than analytical, but I know how to work a calculator.
And then, do you like to make decisions in a slow-paced environment or a fast-paced environment?
Totally depends on the decision being made.
Okay, so that means
there goes my my love for both deep water international and U.S. onshore. U.S. onshore, much quicker pace of making decisions appropriately, much more quick pace of making decisions. Offshore environment, much slower pace, much more technical challenge, etc. But a place for both.
How do you like to learn? Do you like to learn in a slow-paced environment or a fast-paced environment?
I'd say it depends on what I'm learning.
All right, so you're learning how to be a CEO. Is it fast-paced or slow-paced?
For a U.S. onshore company, fast-paced.
Okay. Rule follower or risk taker?
These are these questions where it's like one as it's almost like a bad thing to say you're not a rule follower. Risk taker.
It depends upon the situation.
These are hard questions.
Yeah, it's so dependent. I agree with David on that. So calculated risk taker.
Yeah, that's a good one. So do you tend to be optimistic or pessimistic?
Optimistic.
And then do you have a high trust in others or low trust in others?
High trust in others.
What about yourself? That's an easy one.
Medium trust in myself.
Yeah, that's good. You got to question yourself. I actually journal daily about the things that I'm thinking about. Do you do what you think is right or what you feel is right?
Ooh. I think if you've got a good moral compass, maybe what you feel is right is oftentimes aligned with what you think is right. So
I like that one too. There's this whole, like, you got the most neurons in your brain, but the second most in your heart and the third most in your gut. And so it's like that brain gut connection. So I tend to feel is right as well, but a lot of thought goes into these things.
Yeah.
Curious, so if you think other than becoming CEO of Oasis, what was a crossroads in your life?
Whether or not I was at post APC, what was I going to do? Was I going to come back into industry?
Yeah.
And we saw yes. The answer was yes.
So what were your other? So what was the other road?
So I thought long and hard, honestly, about whether or not I wanted to pivot and go do something else, still within energy. I actually looked at putting together with an increase in. I had a thesis that increased renewable penetration into the grid and increased regulation from the inherent instability that causes, just because the lack of sort of spinning kinetic energies associated with a bunch of generators tied together, synchronized. That their likely sort of control systems on the grid would be in increased demand, and so I looked at trying to start a business associated with that. And ultimately, I loved the industry too much, love what we do, like the people involved, and decided to come back into industry instead.
No, that's an interesting thing. I was actually talking to a friend that bought a house with kind of a 15-year-old control system, and the person put all LED lights in, but a lot of control systems have a resistance factor of knowing if you're dimming or not. Mm-hmm. So they get a feedback loop from your traditional incandescent or halogen. So like that feedback loop of frequency, people don't think about a whole lot, and in around how grids work. And I liked your way of thinking of converting work to electricity that's pretty interesting. We could talk more about that. And that, so yeah, that was helpful.
I was gonna say I got one here. Yeah, I was thinking about I've run my own businesses. David's run his own business before, obviously a smaller scale. One of the biggest things that's a challenge is staffing and good people and, fostering a culture. And as a public company and everything that E&Ps have gone through, not just the last year with COVID and the last 18 months, but really the last, call it since 2014 when oil really fell. How is it when you think about fostering those employees? A lot of young people left the industry. A lot of people aren't wanting to get petroleum engineering degrees, whether because it's the ESG stuff or whether it's just because the market's been hard to find a job. Just as you think about the talent pool and how you guys are managing that and making sure that you're continuing to get young, fresh people in and manage the people that you have. Has that been a challenge? Is that something you think about as a CEO and a leader? I just never thought about it at the scale with a public company.
So it's something I think about every day. I think about it, particularly in this industry, as I worry about, are we graduating the number of geoscientists and petroleum engineers that we need to in order to sort of be sustainable moving forward? Can we attract the accountants and attorneys and IT folks into this industry? Given the competition we have outside the industry, that they've got those choices and some of the societal pressure they've got associated with being part of oil and gas. So yeah, no, I absolutely worry about it. I worry about it even maybe more particularly given the path of our organization and some of the difficult decisions we've had to make along the way to get us to the point where we are right now, which I think I'm very optimistic about and feel like we're in a great place. But it was a lot of tough decisions to get there. And as you sort of retool your portfolio, that means colleagues are sort of parting ways. And that's tough. That's tough for an organization to go through, and sort of even when you end up in a better place at the end of the day, on paper, it doesn't mean that the emotional toll of getting there, while you can be proud of where you ended up, it's taken a toll for you to get to that point. So I think about it. It is absolutely something I think about a lot. And I think what we have to do is, one, talk really talk very transparently and openly about the opportunities that the industry and our organization presents. The place we sit within an energy transition, which is happening, and so we can talk about the time frame. And I think that fossil fuels and hydrocarbons and oil and gas is going to play a meaningful role in energy for many years to come. But it doesn't mean there's not an energy transition going on, where we're going to see increasing other forms of energy adding to the equation as well, which is good, frankly. I think as you look across the sort of global energy consumption is going to do nothing but increases. Population increases and economies continue to grow. So that's a good thing. But I think talking sort of clear-headed about the efforts our company and our industry are making to do things right and to be a responsible operator are important to do as well. And then the career opportunities and the opportunities they have within industry, I think, are fantastic. Frankly, when I think about, the combination of teamwork, technical challenge, but sort of practical in the field, kind of get your hands dirty opportunity where you've got real stuff, tangible things that you can do and control and see the results of. It's fantastic. And so it's one of the reasons why I've always loved industry and loved what we do here. And hopefully we can convey that same sort of, opportunity set and excitement to employees.
So piggybacking on that question real quick, and this is my last one that I really had, and you mentioned this earlier, Danny, around the good things that oil and gas companies are doing. And Hike knows that I'm passionate about the industry. My dad was a geologist and an engineer. I grew up, even before the ESG narratives and all these things you saw on the mainstream. My dad used to tell me when I was a kid, he goes, I feel good about my profession because I know that people use the products that we do. And he's like, I'm not a doctor. I'm not these other professions that you think of as these kind of high moral ground professions. But he always said that he felt like that was important to him, that he worked in something that was helping people. Some people may call oil and gas companies the villains. I think we're the heroes because we help everybody. The moral case for, you're obviously passionate about this industry. Do you feel that same way? And if you could speak to how you feel in terms of those thoughts, just in this time where it's easy to beat up on oil and gas guys.
I wouldn't have come back into industry if I didn't agree with the tenets you just put out. I think that what we do is good for society. Clearly has improved the lives of billions of people. Will continue to improve the lives of billions of people for many years to come. Doesn't mean we shouldn't do it responsibly. Doesn't mean we shouldn't try to do it better and better every day. And for me, I'm one who I'm glad to see sort of solar and wind pick up and add more meaningfully. I think as we think through, places that don't have the ready access to the natural resources that we do, those are really meaningful, I think, and powerful opportunities for them, maybe in a differential way than hydrocarbons can be. If you think through, the fact that they don't have as ready access to them, but they may have more ready access to wind and solar, and certainly the cost for those things have come down tremendously over the past few years. So I'm an all of the above guy, but included in that passionately is hydrocarbons, and certainly the contribution of hydrocarbons have made to society and how it's elevated the human condition over the past 150 years. It's astounding, absolutely astounding what it's done, and it's something that I think is often vilified, and it's part of the reason I think I have such a passion for the industry and wanted to be back in, because it's a little bit, you think of big bad sort of monolithic oil, but in some ways I think we're a little bit of an underdog, and that folks don't recognize this asset about us, and I really like that, because I think what we do is really important and noble, and we're trying to do it. We're trying very hard to do it in the most responsible manner as we can, and we're committed to continuing to do it better and better and better.
That's the cool thing about the podcast. We're real people, and this is an industry that is. You see it just as kind of, you talk about big oil and all these things, and it's not humanized. I think doing things like the podcast, hearing somebody this passionate, hearing you talk about being sustainable and having responsibility, bringing that human element to the conversation, there's a whole giant workforce of people that blood, sweat, and tears every day to make all of this run, right? And oil and gas companies, especially producers, are at the beating heart of pretty much everything. So I love getting excited about it, because I think this whole medium of doing the podcast is important, because we can have the long form conversations where we talk about the nuance, but we also bring that human element to it. But,
I mean, and I say it a lot, like my first job in the oil field was in 1990, and I was a roustabout chopping weeds around wellheads and killing rattlesnakes. But we had a bunch of ceramic pipes in that field that you'd drive over them and you'd have some oil leaks, and you'd turn dirt over on them. Like, that doesn't happen anymore. Like the real, like it's, and so like things are getting better. And so we get demonized for, the obviously Macondo, Valdez, those words resonate in people's minds, but like the trends are actually improving. And like
I agree.
That's the thing that gets me.
And I think the ESG argument is going to do nothing but accelerate that more, because we were doing, for many, many years, we've tried to do things right. And I know Oasis was trying to do things right, and it's evident as we put the sustainability report out. But the increased transparency and the increased sort of accounting around the numbers, on recording the numbers and reporting them every year, that, like any aspect of our operations, is going to drive incremental improvement on those things. So as we measure it more, as we monitor it more, as we report on it more, as we include more transparency, it is naturally going to get more focus and get better. And we were already getting a lot better. And so I think that acceleration is going to be nothing but a good thing. I welcome it, and I think we'll see continued improvement.
Yeah, measure to manage is a simple thing. So probably the most controversial question I'm going to ask you going into Thanksgiving is, would you rather have pecan pie or pumpkin pie?
No, this was the easy one, pumpkin pie.
All right,
that's what I like.
It's a root vegetable that we had an argument in our management meeting that it is the worst thing in the world, and I took your guys' side as well. Pumpkin pie on Thanksgiving is a little bit of whipped cream.
In a pie, pumpkins are gross though. Every time I got to carve them, I'm like, ugh. But I like them in a pie.
Yeah, the little string things that end up on your hand. Yeah, I'm not a fan of that. But
the seeds are good if you salt the seeds in bacon. There's some redeeming quality to the seeds as well, but the actual insides are.
All right, Joel. on that high note, no, I agree completely. Like, the demonization of our business is something that really bothers me, and I'm glad we can have these conversations. And thanks for coming on, Danny. Thanks, Max, for hosting this, and it's something that's been a highlight of my year. So let's keep it up.
All right, thank you guys both very much.
Yeah, definitely.
Yeah, Danny, thank you.